sitting on the sidelines waiting for these mortgage rates to come down is probably costing you more money than you think you're saving. Let's put it all into perspective. Are they really high? Look right here. This is historically speaking how the interest rates have gone up and down over the years. And you can see where we're at right now. Not really high. We're like kind of in the lower third. And what you'll probably find further interesting, if you look at all those vertical lines there, those vertical shaded areas of gray, those represent periods of recession. And you'll see that we've gone through recessions with very high rates. We've gone through recessions with mid-range rates. And we've gone through recessions with very low rates. So the mortgage interest rates don't really have a correlation with an economic downturn, do they? Second thing is, look at this chart. This is the median home prices for the same period of time. And you can see that when we had high rates and low rates, it didn't really impact whether properties were appreciating or not. It's on a pretty steady clip upwards, isn't it? And if we look exclusively at just the recessions, we'll look back the last 7 recessions here, you'll see that in only one of those recessions did it actually result in a market downturn, a housing market crash. So mortgage interest rates don't really have a correlation with the housing market either, do they? So if you are exclusively a cash flow investor, this could be concerning. The mortgage interest rates could definitely have an impact here, because if those payments keep going up, but your rents aren't going up to support them, then that could put a real squeeze on your cash flow. But if you're basing all of your real estate investing decisions on that one profit center, that's akin to just throwing the baby out with the bathwater. I mean, after this, you're going to be the smartest person in the room the next time the subject of housing comes up. Because when it comes to inflation, right now, a lot of people are getting poor because of it. But there is a small group of people that are getting very, very rich because of it. Have you heard of the expression, don't fight the Fed? It's like this. Aligning with the Fed when interest rates are low means you can be a little bit more aggressive. You can take on a little bit more risk. But when interest rates are high, you want to play a little bit more safe. And right now, people are playing conservatively because those mortgage interest rates are high. But I just showed you traditionally, they're not very high. So a lot of people are sitting on the side with the wrong strategy. Here's what I want to show you. The median price of a home 5 years ago was $331,000. Let's say you also had $331,000 of cash in your bank account. So let's fast forward 5 years, and because of inflation, the price of this home today is $436,000. And that $331,000 of cash that you had sitting in the bank today, adjusted for inflation, and now has the value of $273,000. So if you haven't done so already, go ahead and give me a thumbs up for the housing appreciation. And if you don't want to lose your purchasing power, go ahead and hit the subscribe button, and I'll help you out with that because we talk about this stuff each and every week. So this right here, this is just inflation doing what inflation does. The house appreciated, the money depreciated. Here's how you use this information to get rich. What if we went back and we didn't use our own money, but we borrowed this money to purchase this house? We made $105,000 on the property because of inflation. And since we borrowed the debt, we actually only owe a real value of $273,000. Yes, nominally, we owe $331,000, but because of inflation, we owe a lot less, $58,000 to be exact. Inflation actually helps pay down our debt. And when we combine these two, we really increased our wealth by $163,000 by simply doing what the Fed does, by doing what your government does. We borrowed a depreciating asset to purchase an appreciating one. And it really didn't matter what the mortgage rates were doing. This would have happened anyway because we live and operate within a debt-based inflationary system. That's how it works. I mean, how do you think the government is going to pay all their debts back? Well, they're not. They're going to leverage inflation to do it for them. What they're going to do is they're going to go print some more of this money, this depreciating asset, to go and pay off their debts and buy more appreciating ones. They're not going to pay it off. They're going to use inflation to pay it off. And if they can do it, so can you. And you can debate me all you want. In fact, I encourage it. But just understand this is how the wealthiest people in the world are operating. And if you still disagree, you are fighting the Fed. And it doesn't matter how you feel about it. It's just going to continue doing what it does. It's like if you were thrown into a river and you felt like it was the right thing to do to swim upstream. Well, that river, it doesn't care. It's going to do what rivers do. It's going to keep flowing, and you're not going to get to where you want to go upstream. Or you could just turn around and swim downstream with the current and have a much easier go about it. And you can still end up on a very nice bank somewhere. Those banks look just like the banks upstream. That river, it's going to always win. Just like the system is always going to win, despite what the mortgage rates do. They really don't matter all that much when you have this going on. So let's go ahead. I'm going to use the Epic ROI matrix to demonstrate even further why sitting on the sidelines waiting for these mortgage rates to come down is probably costing you more money than you think you're saving.
How could that be?
Alrighty, so let's look at that. Okay, let's use that same house as an example, and we'll use its value today, $436,000, and we'll take a look at where we'll be 5 years from now if we just ignore the mortgage interest rates and just keep on investing as we had been the last 3, 4, 5, 6, 7 years. But we're going to do this a little bit more traditionally. We're not going to borrow 100% of the money. We'll go ahead, we'll go down to Bank of America, Chase, whatever, Wells Fargo, and we're going to borrow 80%. We're going to put down 20%, and that's $87,200. That's our down payment. And we're going to borrow the rest. So that would be $348,800. This is our down payment. This is our loan. All right, so here is the ROI matrix. It looks just like this. And this represents the 4 profit centers of real estate. We've got appreciation, we've got cash flow, we've got depreciation, and we have amortization. So we're going to start with appreciation because this is what most people will look at when they are making a decision whether they want to invest in real estate or not. And you know this because they're going to ask you a question like, hey, do you think this is a good time to get into the market? What they're really asking is, are the prices low and are they going to be more next year? So they're banking on appreciation. That's what that question suggests. So we kind of have to guess and predict what appreciation is going to be. Lawrence Yun, the chief economist over at the National Association of Realtors, is predicting that housing values are going to appreciate about 1 to 2% above whatever inflation is doing. And we know the Fed's target is to get inflation back in check right at about 2.5%. That's where they like it to be. So if Lawrence is accurate, home values will probably appreciate 4, 5, 6% a year over the next 5 years. And if we go back and look 20, 30, 40, 50 years, as long as we've been keeping records, that is about the average annual appreciation rate, about 4.5%. I think it's going to be much higher than that. I think we'll probably pull back a little bit before we go forward again. We'll just keep it very conservative and predict that we're going to appreciate 4% a year over the next 5 years. And that would be 20%. So our home value is $436,000. Multiply that by 20%. Our property will appreciate over the next 5 years by $87,200. Now we want to calculate our return on investment. And our actual investment here, when we borrow money, is not the whole amount. It's the down payment, the amount of money of our own money that we put into the deal. Coincidentally, it's the exact same number. I didn't predict that. I didn't think that through. But 20% appreciation over the next 5 years does equal 20% of a down payment. So what we want to do is we want to take the amount of money that we made per appreciation and divide it by the amount of money we put into the deal, which was $87,200. And that will give us a 100% return on our $87,200. So let's look at the cash flow now. This is probably where the mortgage interest rates are going to have an impact. So I just did a little bit of browsing on the internet and I found properties around this value that rent for anywhere from $2,500 to $3,000, $3,500. Most of them are right around $3,100, $3,200. I looked in Vegas, I looked in Arizona, I looked in Texas, I looked in Florida. And based on what we do here at Cash Flow Savvy, we provide turnkey properties all through the Midwest. That number's about right, about $3,200. So I'm gonna go ahead and use that number, $3,200. That's the revenue, the monthly income that you could expect to receive on a property valued about this. Now, from that revenue, we have property expenses to consider. We've got taxes, we've got insurance, we've got maintenance, we got vacancy, we have property management. And so my quick and dirty math number for that is about 40%. We'll get to keep about 60% of this income right here each and every month. So if I multiply this by 60%, that's going to give me $1,920 a month that I get to keep. Now, from there, I have to make my debt payments. I have to pay for the money that I borrowed over here. So I did a quick calculation at 6%. And what that payment would be is $2,091 a month. So you can see we're a little bit negative, aren't we? This is where the mortgage interest rates actually do have an impact on your investing. But remember, it's just one profit center. And we'll pull the whole picture together at the end and we could decide whether that's enough for us to get back into the market or for us to wait. So what that gives us is a negative cash flow of $171 per month. Over a year, that's negative $2,052. Multiply that over our 5 years that we're calculating for right now, and that's a loss in the cash flow department of about $10,000. $10,260 to be exact. And so what we'll do is we'll take this number and divide it by how much money we put in the deal, which was $87,200. And then what that gives us over a 5 year period is in a negative 11%.
That stinks.
He's not done yet.
Now, let's look at depreciation. A lot of people don't factor this into their investment decisions, but it can be a very significant number, particularly when you start adding multiple properties to your portfolio. And what depreciation is that the IRS tax code gives you a tax credit as a property owner for the natural wear and tear on your property. And they give you that deduction for a certain period of time, what they've determined the usable period of that property. And I don't know how they came up with this number, but they came up with 27.5 years. But they don't allow you to depreciate the entire value. They only allow you to depreciate the structure itself. They won't allow you to depreciate the land because the land doesn't really depreciate. It'll still be here in 50 years, 100 years. So what they'll do is they'll allow you to depreciate 80% of the property value, the purchase price. And 80% will then be this number right here, $348,800. Made the math really easy because we borrowed 80% and we need 80% of the property's value. Now we'll take this number and divide it by 27.5 years. So that allows us to depreciate $12,683 a year. Now we have to multiply this by our tax bracket. And that brings a big variable. So it's going to be a little bit different for everybody. But I'm just going to choose the middle of the road tax bracket of 33%. And that comes out to $4,185 per year that we don't have to send to Uncle Sam. And if you get set up correctly with your finances and your taxes, get a good CPA, get a good accountant. And what you can do is you can deduct this from the amount of money that you would have to send via your job. So if you have to pay $10,000 of taxes from your salary, but now you have this deduction of $4,000, that's like what, just $6,000 you have to pay to the IRS instead of the whole 10. And a lot of people don't really factor that in and don't consider that as a return on their investment in purchasing the property. But it indeed is. It's not necessarily money that's going into your bank account, but it is specifically money that is not leaving your bank account. So it is indeed a return. Now, this is annually. We need to multiply this by 5 years because we're doing a 5-year projection. And that gives us $20,973. Yet we did not have to send to the IRS. Now, we'll go ahead and we'll divide that by the amount of money that we put into the deal. Again, $87,200. And in this profit center, that equates to a 24% return. That's a real return, isn't it? Now, let's look at the amortization. This is the paying down of the debt. And a lot of people don't consider this because they're so used to paying the mortgage on their own house, and they have a hard time kind of getting a grasp on how me paying money back that I borrowed is an actual return. Well, when it comes to your primary residence, it's not, because it is you paying yourself. You're paying back the loan. But when it's an income property, it's your tenant that's paying down the debt. The tenant gives you their rent each month. You take that rent, go ahead and pay the expenses on the property, then you pay the debt service, and you get to keep what's left over. That's how it works. So the tenant is indirectly paying down your mortgage. They send you the money so you can send it to the bank. This is the big distinction that makes an income property an amazing investment versus your primary home, not so great of an investment. Financially speaking, the numbers don't really pan out over 30 years. I'll go ahead and I'll put a link down below, kind of breaks that down. But when the tenant is paying down your mortgage, that changes everything. So I just pushed pause and I ran to my computer really quickly. I pulled up an amortization calculator and looked at the actual schedule of how the principal is paid down based on the numbers that we have right here after making these payments of $2,091 a month to the bank over a 5-year period. It paid down your principal by $23,760. Now we'll take that, divide that by how much money we put into the deal, which is our $87,200, and that gives us a return of 27%. Nominally, you paid down your debt by $23,760. Subtract this from how much you borrowed, and that puts you right about $325,000 nominally that you owe back. But adjusted for inflation, 5 years in advance, actually it's about $283,000. Inflation paid your debt down even further by about $40,000. And if you wanted to calculate with the return on inflation, that's probably going to put you somewhere right about double this number, 50-60%. But let's just go in and add up the real returns over 5 years. We've got 124% plus the 27% here, so that's going to give us 151% return. And then we have a negative 11% on our cash flow. So that puts us at right about 140% return on our 20% down payment over 5 years. Now, when you take all of this into consideration, do mortgage interest rates really matter all that much? Are you going to forego a 140% return merely because you want to avoid this 11% loss. Your call. You can do what you want to do. Just something to consider, though. You should have the whole picture as you're making these important decisions about your finances. But here's the deal. If the mortgage rates, if they do indeed come down and you mistimed the market and you got in at the wrong time and you could have saved some money by getting a lower interest rate, then just refinance. No big deal. It's really easy to do. But if the mortgage rates go up, look how you've accurately timed the market. You're going to look like an absolute genius because you got in now. So do those mortgage interest rates really matter? I don't know. You tell me. Tell me down below in the comments. I want to know. I read them all the time. Let me know what you are thinking. And who else do you know that needs to see this? When that name comes to mind, please share with them. Thanks for watching. I'll see you next time. Take care.